What if the biggest financial crashes in history were not accidents, but proof that the system worked exactly as planned? Every time markets collapse, people lose jobs, savings disappear, and families fall behind. Yet banks survive. Debt survives. The system survives. So ask yourself, why does money always recover faster than people? To understand this, we have to go back to the very beginning, before modern banks, before central authorities, when money was limited by real things like gold, land, and labor. Back then, when systems failed, everyone felt the pain, including those in power. That changed when banks discovered they didn't need to keep all the money they were given. By lending most of it out, they could create profit from promises. This worked in good times, but in bad times, it caused panic. When people rushed to withdraw their money, banks collapsed. So governments stepped in, not to protect people, but to protect the system itself. Central banks were created to stop total collapse, even if individuals suffered in the process. Stability became more important than fairness. Over time, money stopped being a store of value and became a tool of control. With fractional banking and central authorities, money could now be created from debt. The more debt that existed, the more the system grew. Wars, recessions, and emergencies made the system stronger. Gold became a problem because it limited spending. So governments removed the limits. In 1971, money was no longer backed by anything real. It was backed by trust, and trust had to be defended at any cost. From that moment on, crashes didn't disappear. They were managed. When markets failed, central banks printed money, lowered interest rates, and rescued financial institutions. But that money didn't reach ordinary people first. It went to banks, markets, and those closest to power. Then came 2008. The system broke in plain sight. Banks took reckless risks, and when everything collapsed, governments stepped in with trillions. Homes were lost. Jobs vanished. Futures were destroyed. But the system was saved. This revealed the truth. The goal was never to protect people. The goal was to keep the machine running. After every crisis, the same pattern repeats. Asset prices recover. Debt grows. Inequality deepens. Inflation quietly transfers wealth from workers and savers to those who own assets. This isn't corruption. It's how the system is designed to function. Reforms are promised. Regulations are announced. But the core never changes. Because changing it would make the system fragile again, and fragility is unacceptable to those in control. Today, the warning signs are everywhere. Record debt, permanent emergency policies, markets dependent on central banks. Crashes are no longer rare disasters. They are expected events absorbed and recycled into the system. Modern money is not designed to serve people. It is designed to survive crashes. It prioritizes stability over fairness, control over consent, and systems over lives. So remember this, crashes are not failures. They are stress tests. Those closest to money creation are protected.